Welcome to Gold Compass Guide, where macro signals, gold insights, and wealth protection strategies help you navigate uncertain markets. To understand where markets may be heading next, it helps to pay attention to what's happening quietly, away from headlines and daily noise. Let's hear what Adam has to say.
Something unusual is happening in global markets. While headlines remain focused on stocks, real estate, and cryptocurrency, a quieter shift is taking place beneath the surface. Central banks, institutional investors, and long term wealth preservers are steadily increasing their exposure to gold, often without the attention typically seen during major market moves. This is not a sudden rush driven by panic, it is a gradual, deliberate accumulation. And historically, quiet accumulation phases tend to happen during periods of uncertainty, when confidence in future economic stability begins to weaken, even if markets appear calm on the surface. To understand why this matters, it helps to look beyond daily price movements and instead focus on the broader environment shaping investor behavior. Inflation remains persistent across many economies. Even as headline numbers fluctuate, the long-term impact on purchasing power continues to influence how individuals and institutions think about wealth preservation. At the same time, interest rate cycles have introduced a new level of unpredictability. Rapid increases, followed by expectations of potential cuts, create an environment where traditional portfolio strategies may feel less certain than they once did. Layered on top of this is a growing awareness of global debt levels, currency volatility, and geopolitical friction, all factors that historically push investors to consider assets that exist outside of financial systems dependent on policy decisions. Gold has played this role for centuries, not because it generates income, not because it promises explosive growth, but because it offers something different: independence from monetary policy and resilience during periods of structural uncertainty. What makes the current environment particularly interesting is the behavior of central banks. Across multiple regions, central banks have been increasing gold reserves as part of long-term diversification strategies. This trend reflects a broader desire to reduce reliance on individual currencies while strengthening balance sheets with assets that carry no counterparty risk. This type of accumulation rarely happens overnight, and it rarely attracts dramatic headlines. Instead, it unfolds quietly over time, reinforcing the idea that gold is often viewed less as a trade and more as a form of financial insurance. Institutional investors follow similar patterns. During periods when equity markets are strong, gold may appear less attractive. But when volatility increases, correlations shift, and confidence becomes less predictable, portfolio managers frequently revisit allocation strategies designed to preserve stability rather than maximize returns. Gold's role in these strategies is subtle but significant. It does not need to outperform every asset. Its value often lies in behaving differently when other assets struggle. Historically, many of the strongest gold cycles have not begun with retail excitement or dramatic headlines. Instead, they have emerged from extended periods of quiet positioning, phases where accumulation happens gradually before broader awareness catches up. This dynamic is less about predicting immediate price movements and more about understanding investor psychology. When confidence is high, protection feels unnecessary. When uncertainty rises, protection becomes a priority. Gold sits at the intersection of those two emotional states. It represents optionality, the ability to hold a portion of wealth in a form that does not rely on earnings reports, interest rate decisions, or corporate performance. In today's environment, where economic narratives can shift rapidly and long-term certainty feels increasingly complex, that optionality carries a unique form of value. This does not mean gold replaces other investments, nor does it imply that accumulation guarantees dramatic price movements, but it does highlight a recurring pattern. During periods of structural transition, when investors reassess risk, diversification, and long-term purchasing power, gold tends to quietly re-enter the conversation among those focused less on speculation and more on preservation. The silent accumulation happening today reflects that mindset. It is not driven by urgency, but by awareness, not by hype, but by preparation, and whether or not gold becomes a dominant story in the months ahead. Understanding why sophisticated investors revisit it during uncertain periods offers valuable insight into how wealth is protected across market cycles. Because in the end, gold is rarely about chasing opportunity, it is about maintaining resilience when certainty fades. If you found this perspective helpful, consider subscribing to Compass for calm, data driven insights on gold, macro signals, and long term wealth protection strategies.